Hey, it's Tom here and welcome back to the channel. Now, just yesterday I was scrolling through Twitter. I am at Tom Investing on Twitter if you don't follow me there already. And I saw a brand new tweet from Bill Ackman. Bill Ackman was saying, "We recently purchased more than 3.1 million shares of Netflix, which makes us a top 20 holder. I've long admired Reed Hastings and the remarkable company he and his team have built. We're delighted that the market has presented us with this opportunity." And then it gives a link to a press release from Bill Ackman's basically publicly listed fund, Pershing Square Holdings. So this is a really big move from Bill Ackman. Bill Ackman at Pershing Square runs a really concentrated portfolio. If we look at his 13F, we actually only see 6 holdings in the US, at least that is. And this 3.1 million shares of Netflix that he's acquired would give him a stake that at current prices is worth roughly $1.2 billion, and that would make it about his 5th or 6th largest investment. It would be about the same size as his investment in Howard Hughes, and it would be slightly larger than his fairly recent investment in Domino's Pizza. So in this video, I want to share some of the key points in the press release that accompanied this tweet from Bill Ackman around his 5 or 6 kind of reasons why he purchased into Netflix in the first place. And then I want to basically give you my view on the business and whether it is something that I would be interested in potentially investing in at the right price as well. So if we jump over to the press release, Bill Ackman lays out 6 what he calls highly favorable characteristics of Netflix's business. The first one being it's subscription-based, highly recurring revenue, which have enormous future growth potential. Secondly, a truly best-in-class management team and unique high-performance culture. Consider Netflix's remarkable pivot from DVD rental by mail to video streaming to becoming one of the greatest producers of beloved content ever. Thirdly, he lists economies of scale and superb quality in its industry-leading content, which should continue to drive future growth and widen the company's powerful competitive moat. Next, he lists pricing power derived from the enormous value it delivers to consumers compared with other alternatives. Substantial margin expansion with opportunity for continued improvement due to economies of scale and the company's rapidly growing global subscriber base. And finally, and this is the point that I will definitely get into in this video, an improving free cash flow profile, which should allow for continued investments in growth as well as the return of cash to shareholders. And Bill Ackman goes on to give some more commentary around when he first started researching Netflix and how it's a company that he's kind of followed and admired from a distance for a while, and how it kind of was linked up with his recent UMG, Universal Music deal as well. So I'll leave the full press release link down in the description if you want to check that out. But for the rest of this video, I really want to focus on some of the key characteristics of Netflix's business, look at their financial performance, and kind of give you my thoughts on this whole thing as well. Alright, so in terms of Netflix's business, I really don't think I'm going to have to spend too much time explaining kind of what Netflix does. They are the largest, subscription video streaming platform in the world, and probably most of you watching this video are subscribed to Netflix, or maybe someone in your family is subscribed to Netflix and you've got the login. That is, that's an ongoing problem with Netflix that we probably won't discuss in this video, but I'm sure you all know what Netflix is. And Netflix has actually had one of the best performing stocks in the entire stock market over the last 10 or 20 years. It's been an absolute home run. You would be a very wealthy individual had you put a substantial amount of money into Netflix maybe 10 years ago. And the stock is actually down approximately 50% from the highs that it reached last year. And this is kind of the opportunity that Ackman describes the market presenting him, and it gave Pershing Square an opportunity to buy into Netflix at what he clearly sees as an attractive price. And in terms of the business model for Netflix, it's a pretty straightforward equation. Basically, you have a subscription product where people are paying you on a monthly basis, and in order to grow your revenue, you can either increase your number of subscribers or you can increase the average amount that you're charging each of your subscribers. And in the case of Netflix, I'll put up some charts on the screen here where they have basically been able to push up both of those levers over time. It's allowed them to grow a much larger audience. Over time, they have increased the cost that they're charging to their subscribers, and I'm sure that will continue to grow over time. And it has really exploded the kind of revenue and net income for the Netflix business. And in terms of streaming, at least, Netflix has had quite the transition over maybe the past 4 or 5 years. They really started out with their streaming service as basically licensing content from other companies, whether that's Warner or Disney or whatever kind of other media company. They were basically licensing that content to put onto Netflix to show to their subscribers, and they clearly still do a very large amount of that. But over time, they've started to transition more and more towards Netflix original content, whether that's creating their own movies or their own, shows, or whether that's, stand-up comedy or whatever it is. They've really started to build out their own basket of Netflix original content. And I think that, again, is a trend we'll continue to see with Netflix. They're probably doing this for a couple of different reasons. Firstly, it makes them kind of the master of their own destiny. They're not at the mercy of a media company in terms of controlling the prices that they have to pay to actually get that content onto their platform. And we've also seen many rival subscription services kind of pop up, whether that's Disney Plus or an HBO service or Discovery or any of these other kind of streaming services that now exist. Disney, for example, used to have a lot of content on Netflix, but that's now been pulled over the last couple of years. And any content that is kind of still on the Netflix platform, which I think there is still a small amount, will eventually get pulled and will end up on, obviously a Disney Plus service. So in order for Netflix to continue releasing new content and high quality content to their subscribers, they've started to basically spend money on making it themselves. Now, Netflix clearly has a great product and a very sticky customer base and a growing customer base, which I really can't see that will stop growing anytime soon. But their underlying business model has some really interesting kind of financial characteristics. And there's a couple of reasons why I've always personally at least really struggled to get over the line with really being interested in making an investment in Netflix. And it's basically to do with the balance between sort of accounting profits and actual cash flows that are turning up in the bank and able to be, returned to shareholders and so on. If you look at the profit and loss, and I guess the bottom line on that profit and loss or income statement being the net income, Netflix shows a lot of accounting profits, and those accounting profits have really grown very, very substantially over time. I'll put a chart up on the screen here so you can see that. But whenever you start to get into the value investing world, and particularly if you go on to study Warren Buffett and some of his thoughts on accounting profits versus cash flow and so on, what someone like Buffett really cares about is something that he would describe as owner earnings. So how much cash can I as an owner put in my pocket at the end of each year and redistribute elsewhere or spend or reinvest in the business or whatever it is. He doesn't really particularly care what shows up on an income statement, although that does obviously show him a lot of the key characteristics of how the business works fundamentally. But what he really cares about is cash flow. And if we look at the free cash flow for Netflix, that has really been negative for a number of years, and it's actually been increasingly negative basically each and every year up until 2020. And the reason for that, like I say, is they're spending more and more money on content and creating their own big library of Netflix original content. And we actually really interestingly saw in 2020, when obviously the world was kind of shut down and there was a lot of restrictions around Netflix even being able to make new content, they really turned a lot of that spending off. And we got a small glimpse at just how cash flow generative Netflix can be if they really turn off that content production machine. But the key question that we will get into in this video is, can they really turn that off? Can they really just stop making content, or will subscribers slowly start to kind of churn off and cancel subscription if they're not getting a constant flow of new content from Netflix? And of course, anytime you have accounting profits but you have poor free cash flow and you continue to have increasingly negative free cash flow, you have to get that money from somewhere in order to continue creating this new content and keep spending. So we've basically seen the long-term debt for Netflix grow at a pretty substantial rate over time as well. We haven't seen them issue a lot of shares. They're not really diluting shareholders. There's been maybe 0.5% to 1% per year dilution, nothing super substantial in that department. But you can only burn cash and borrow money for so long, right? So at some point you would hope that this will turn around for Netflix and they're getting to kind of the scale at which they can start to have those cash flows move the other direction. So yes, we have great accounting profits, we have a great growing user base, but we really have a very poor cash flow profile. And it was really interesting to see Bill Ackman actually mention, an increasingly positive cash flow profile at Netflix. I really am not quite across the line with him on that one just yet, but Bill's a lot smarter human being than me, and maybe I'm missing something here. So for Netflix, that kind of remains the big question for me, is if they keep investing in new content, really how durable are these assets, and can they ever stop producing new content, or is it going to be just a constant outflow of cash in order to create new shows? There's certainly businesses that have kind of won at this game before and have spent a boatload of money on new content and got to sufficient scale for that to be a cash flow positive exercise. Disney obviously is a shining example of that, but whether Netflix can achieve that same kind of feat is just something that I really don't know the answer to. The capital expenditure and spending on new shows to me is kind of like the streaming equivalent of owning a rental property and putting really expensive paint on the walls. And the question you have to ask when you spend money on that paint and make the house look a little fancier is that something that's going to bring in more higher paying tenants over time, or more subscribers to Netflix over time, or is it really just something to keep existing tenants and existing subscribers happy? I don't really know the answer to that, and that's kind of how I think through it personally. Now, there is another business in the kind of content and video game which has quite a different business model that I actually find a lot more attractive, and that business is what you're watching this video on right now, which is YouTube. If we contrast the Netflix business model with the YouTube business model, we find some really interesting things. YouTube basically doesn't pay for their content. I make these videos for YouTube and I put them on YouTube, right? And that guarantees kind of a couple of things. You have this endless stream of creators, hoping to share their ideas or maybe make money off YouTube, and it ensures that the content's always relevant and there's always new videos coming out. And YouTube basically doesn't have to do a lot in order to keep their content relevant and have something kind of for everybody that comes on the platform. Now, YouTube obviously pay their creators, so as a YouTuber myself, I get to keep 55% of all of the ad revenue that I make off of YouTube, which means that Google or YouTube keeps 45%, so they have a gross profit margin of 45%. Now, if you look at the gross profit margin for Netflix, they've actually expanded that gross profit margin over time, and they're actually getting pretty close to about that 45% number as well. Now, with those underlying characteristics, would I rather own YouTube via Google? We can't own YouTube directly, unfortunately. Would I rather own Netflix? I would probably tend towards YouTube, although Netflix does have, the opportunity to have a little sort of operational leverage kick in. If they can increase their subscription rates by $5 a month, for example, that's basically $5 per subscriber that effectively goes directly to the bottom line. Maybe some of that gets spent on making, again, new content, and it's sort of a never-ending cycle of no cash ever actually being produced at Netflix. I don't quite know, but that is a real key driver that Netflix has over YouTube. I don't think YouTube could really shift that 55% given to creators down to 50% in order to increase their own margins. Maybe that is something they will do at some point, but I think Netflix has sort of an easier time at least increasing prices and getting some operational leverage kick in. So that is definitely something on the side of the Netflix business model. So for Netflix, it really is quite a simple equation. They're going to need more subscribers, they're going to need to probably charge more per subscriber over time, and they're also going to have to be disciplined in terms of spending on content. They are already at immense scale. Again, I'll put their subscriber numbers up on the screen here, but there has to be kind of a certain scale at which the cash flow profile, as Bill Ackman is kind of describing it here, must move positive. And for me, if I were to try and value something like Netflix, those are some of the factors that I would consider. I'd be looking for, what's the expected subscriber growth, what's the expected average revenue that they'll generate from each subscriber, and how sustainable are those growth trends. And if I'm looking out maybe 5 years or 10 years, where do I really think that Netflix can get to with that top line revenue? And also, how is their cash outflows grown over time in terms of what they're spending on new content? Will the revenue grow much faster than their content spending? Can they keep that kind of flat or growing a little bit and grow the revenue a lot faster and actually get to generating some real free cash flow? Or is the content spend just going to continue to follow the revenue growth forever and we never actually generate any cash? Those are the questions that I would be looking at answering if I was investigating Netflix. And you would hope that there's an inflection point somewhere. If you go through that mental exercise and you figure out that Netflix are going to need 1 billion subscribers and they're going to need to charge them $50 per month or something, then you need to figure out whether you think those assumptions are reasonable. And unfortunately, that's just not something that I've been able to get across the line with. So this has been a super interesting move from Bill Ackman. I genuinely think that Netflix have a fantastic shot at kind of winning the streaming wars. I think they probably already have to a large extent. And I think that if they can get to a state where they are generating real free cash flow, they're going to be an extremely valuable company, and Bill Ackman will probably do very well on this investment. But unfortunately, it's in the too hard basket for me, at least at current prices. But nonetheless, super interesting one to follow, and I do hope you enjoyed some of these thoughts in this video on Netflix. If you did, please hit like and also subscribe to the channel if you're new here. But that's it from me for this one, and I'll see you in the next video. Cheers.